Welcome on the line, guys. This is David Jennings just calling in from freetradingsystems.org, and I've been very fortunate to line up an interview this afternoon with Bill Poulos. Now, for those of you who haven't heard of Bill, he's actually been a trader for over 30 years, and he's been mentoring for 7 years, and he's quite well known for quite a few different high-quality courses that have come out over the past few years. We've got most recently the Forex Accelerator, the Quantum Swing Trader, and Instant Profits. Now, I've known Greg, that's Bill's son, for a few years now, and sort of just getting to know Bill a lot better, especially through working through the quality of his courses. And I really wanted to get him on the line. I thought it would be valuable to have a little bit of a chat, find out what he's up to, find out how he approaches the markets, because I always find it's extremely valuable to listen to other successful traders, and you might, glean something. You might hear one new distinction that Bill puts on the way that he trades that may have massive impact for the way that you end up trading the markets. Now, if I do sound a little bit croaky throughout the interview, that's just because I'm on the tail end of a little bit of a cold, but we should be able to battle through. So, firstly, I'd just like to welcome Bill on the line. You there, Bill?
Yes, David, I'm here.
Excellent. Thanks for jumping on. Really do appreciate your time. As I sort of was saying, the reason I asked you on the call was I was very interested to find out, I suppose, three main things. One, how you trade the markets personally. What are the actual strategies that you use, and what it is that you're up to at the moment. So I suppose to start, how do you personally approach the market?
Terrific, David. It's a pleasure to be with you as well. And I appreciate this opportunity to share some thoughts with you. Well, my approach to the markets is one where I'm always looking for the high probability trade opportunities in any market, whether it's stocks, Forex, futures, ETFs, doesn't matter. I'm looking for what I would call swing trading opportunities where the trade lasts from anywhere from maybe a week to 5 weeks. And I trade end-of-day daily bar charts. I found that, at least in my case, while money could be made day trading, in terms of the time invested, it's far, far more lucrative to spend a few minutes each night. That's another hallmark of the way I do it. I don't want to spend more than 20 minutes a night trading the markets, and so I trade on an end-of-day basis using swing trading strategies.
When you talk about swing trading strategies, perhaps you can go into a little bit more, because I know there are some people who aren't really familiar with swing trading. Is that similar to some sort of position trading, or are we looking for trading with the trend? That's my understanding of it, but I know you'll have probably a deeper understanding since it's the method you use.
Yeah, that's a great question. Well, the swing trading characteristic is one where, you are trying to take advantage of the prevailing trend, and you're trying to look for low-risk entry points that can be highly profitable, but where the risk is very definable and acceptable to you in terms of risk-reward trade-off. And so you're not trying to pick tops and bottoms with swing trading. You're trying to get on board at these excellent points in the progress of a trend, and once on board, you expect it to play out in a matter of days or a few weeks at the most, and then you're out. And the great thing about that is you don't have your capital tied up, for months on end in a position that might be going nowhere, or crawling slowly, and so there's an opportunity cost. If you're in the wrong kind of market for a long time, you're missing out on other markets. And with swing trading, you find out right away whether or not your trade's going to work out. And if it doesn't, you go on to the next opportunity.
With that as well, obviously without giving away the actual methodology and what you use to actually enter into a particular position, but with with swing trading, the idea is it to buy, are we looking at we've got obviously the underlying trend which we're trading with, but are we looking for moments of weakness in that underlying trend, or are we looking for moments of strength? Is it making new highs, or are we making, in the shorter term, are we making some lower, like on the pullback, on the weakness there?
Yeah, that's really good. I've found about 4 different methods that are very useful in that regard. And this is really powerful because if you just have one method, you'll tend to miss a lot of opportunities. And this is why I say that. One method would be to buy on it. Let's talk about an uptrend. To buy into an uptrend on weakness as it's correcting back down, and you buy it as it's coming down into strong support.
Oh, sorry, we dropped out for a second there. Could you just go past that last sentence? Sorry, my line dropped out just for a second.
Okay. So one approach would be to buy on weakness in an uptrend. So as the market's falling in an uptrend into a level of support, a strong level of support, where even though it's correcting down, you're confident enough at that support level to buy it on weakness. And then you got to give that kind of a trade a little bit more room than the next method, where you would wait for confirming strength before you buy. In other words, the market's trending up, it trades down, corrects down, but you don't buy in until you get confirming strength. And that way you can place your stop a little bit closer.
Yeah.
Okay, and then another method would be where a market is really strong, exhibiting significant momentum. It might stutter and consolidate sideways, but never really go down much. And what you want to do there is get on board if it then jumps out of that consolidation and keeps on going up. And you got to be careful. There are so-called pennant and flag formations that try to do that, but there's so many false breakouts with those. I don't find that they work that well. So you need to define a little more carefully that situation to take advantage of it.
Yeah, so I think the other question I had then, I suppose, in terms of the way that you trade the market, then obviously setting the width of the stop as well. How are you actually setting your stop? Do you have a couple of different methods that you're using, or is there one particular method? All the traders out there, I'm sure, we're starting to get familiar with the idea of having your initial stop and then having a trailing stop as well. And if traders aren't using that, they should definitely do some research on that. But how are you looking at calculating those things?
Yeah, that's really good. The overriding guideline that I use that is extremely important, that a lot of traders completely miss, is you want to place the stop where you don't expect the market to go.
Yeah, agreed.
That is really significant, because if you don't do that, you might as well just send a check to the broker right away, because your stop's going to get hit. And
it's funny the way. Oh, sorry. Go
ahead.
I was just going to say, it's funny. I think that's one of the biggest things that I see people do. One of the biggest mistakes they'll make is setting inappropriate stops within normal daily volatility, or even whatever time frame they're trading. They'll set inappropriate width stops, and it's almost like you're not even giving the trade the chance to succeed, because it's almost like you're cutting it off at the legs just by setting your stop too tight.